As a finance professional in a disrupted business landscape, what does it take to be in demand? What does it take to attract great paying international roles? If you're an ICAN member, it'll just take one exam. That's all it takes to complete the globally recognized CIMA professional qualification and the internationally respected CGMA designation. As a CIMA member and a CGMA designation holder, employers will look at you as a finance professional, constantly acquiring new skills to add value to the business. That's why they'll be willing to pay premium to hire and retain you. If you have 5 years of relevant experience and are an ICAN member, you can directly sit for the final exam of the CIMA Professional Qualification, the Strategic Case Study Exam. Start studying the CIMA Professional Qualification. Prepare to make an impact.
Good evening, Federal Accountant of Nigeria. I'm glad to welcome you to another episode of ICAN-ngr today, a great platform for learning which is powered by our noble institute, the Institute of Federal Accountants of Nigeria. I'm your host for today, Tosin Akinwumi, FCA. And please don't forget to inform your colleagues and friends that the show has commenced. I mean, their handles, the Facebook page, and the ICAN YouTube channel. And today, Thursday, 29th February 2024, we have the opportunity to speak on another topic, unbundling the complexities of transfer pricing. And I have here with me a distinct, the partner services, Ernst & Young Nigeria, Mr. Temitope Oni, who shall be speaking on today's topic. Of course, you should know that we bring in experts on ICAN-ngr show. Certainly, it is a platform for learning. So let me quickly go on a short commercial. I'll be right back with my guest on the show today. Don't go away. Stay tuned.
As a finance professional in a disrupted business landscape, what does it take to be in demand? What does it take to attract great paying international roles? If you're an ICAN member, it'll just take one exam. That's all it takes to complete the globally recognized CIMA professional qualification and the internationally respected CGMA designation. As a CIMA member and a CGMA designation holder, employers will look at you as a finance professional, constantly acquiring new skills to add value to the business. That's why they'll be willing to pay premium to hire and retain you. If you have 5 years of relevant experience and are an ICAN member, you can directly sit for the final exam of the CIMA Professional Qualification, the Strategic Case Study Exam. Start studying the CIMA Professional Qualification. Prepare to make an impact.
Yes, welcome back to ICAN-ngr. And I have here with me Mr. Temitope Oni, the partner tech services Ernst & Young Nigeria. Mr. Temitope Oni, it is a pleasure to have you on ICAN-ngr today.
Thank you, Mr. Tosin Akinwumi. It's my pleasure to be here today.
Thank you very much. We appreciate your coming. Now, quickly, let me make Mr. Tope known to all our viewers for today by taking his brief profile. Temitope is a partner in Ernst & Young Tech Service Line and leads the transfer pricing practice. He is a first-class graduate of agricultural economics from the University of Ibadan, Nigeria, and a chartered accountant with over 14 years of practice experience. Industry experience in services. tax compliance, and advisory services. He has been involved in several tax consulting and transfer pricing services involving companies in consumer business and transportation, telecommunication, oil and gas, shipping, and service-oriented sectors are in global, regional, and local TP documentation, TP planning, TP advisory, TP audit support, cost contribution arrangements, advice on permanent establishment issues, audit of permanent establishments in Nigeria. Dear viewers at large, this is the and like I usually mention, this program affords professionals and business owners the opportunity to showcase their wares at affordable rates. The reach of this program is global, and I assure you once again that you won't regret your partnering with us. So sit back and relax as we go through so Mr. Tokwe, pricing, especially in Nigeria. So let me start this way. A life has and will always have its intrigues. And what looks very simple to someone may look very complex or complicated to another person. So having you on the show today as a guest, I will certainly grant our global viewers the opportunity to learn, to share, and unbundle the real or perceived complexities associated with transfer pricing. So in simple and professional terms, what is transfer pricing? And what are the types of transfer pricing that we have out there?
All right, thank you, Mr. Kinkumi. Transfer pricing essentially is, how we set prices for transactions between connected persons. And when we say connected persons, we're basically talking about related parties. We're talking about associated enterprises, companies that are related by way of ownership, by way of shareholding, by way of common directorship, and the likes. And for the purposes of this discussion, you will hear me use the set of words related parties, connected persons, interchangeably. They all mean the same purpose. They mean the same thing for this purpose. Now, one thing that is important we keep in mind is that when we're talking about transfer pricing, we're actually looking at the prices that are set between related parties operating within the same group. Transfer pricing is not a concept that we use within the framework of a third-party environment. Is what is used within the context of a group setting. And transfer pricing, as it were, we say it thrives on the concept of the arm's length principle. When we're talking about the arm's length principle, we're basically looking at how conditions are set between related parties when they have their commercial and financial relations. And we're basically saying that the conditions that are set between related parties are expected to be about the same conditions set between unrelated parties when they are transacting. And whenever you have differences between those conditions, it would distort, profit that are attributed between related parties, and by extension, it will also distort, the tax revenues earned by government of host countries. And that's the reason transfer pricing is actually of a great importance, because it ultimately determines how profit is shared between parties involved in a controlled transaction. And as a result of that, it also affects the tax liabilities, right, that are actually paid to government of different jurisdictions where those companies are resident. And that's the reason, it's really a topic of great, importance. I'll stop there around transfer pricing. Now, when we're talking about types of transfer pricing, types of transfer pricing is really not a popular concept, but what we say here about transfer pricing is that it applies to both domestic transactions and cross-border transactions. When we say domestic transactions, we're looking at that transactions between companies that are related and operating within the same jurisdiction. For instance, company A and company B that are both resident within Nigeria tax jurisdiction. The transaction between those two entities are viewed as domestic transaction. And we also have cross-border transaction, which of course, relate to transactions between entities that are operating across, different jurisdictions. So from that perspective, that would be, my response to your question as to types of transfer pricing.
Thank you very much. What actually amazed me is that in just within 2-3 minutes of your response, you have actually dropped not less than 10 different jargons, connected persons, but just that you have also prepared our minds to know that there will be the continuous usage of such words. And I'm sure our viewers will also need to be prepared to understand those actual words, because we need to unbundle the complexities, no matter how complex it is being perceived. The concept, even now. Okay, so moving along from where we stop. So what do you say are the characteristics of transfer pricing? And are there unique approaches for determining a transfer price?
All right. So, in terms of transfer pricing characteristics, a couple of points I think I pivoted there. The first is for us to appreciate the fact that transfer pricing actually requires, multidisciplinary team. It requires also multi-country knowledge. And what do I mean? Transfer pricing is really, a concept that we typically use for cross-border transactions in many jurisdictions of the world. Like I did say, in Nigeria, we say it's applicable to both domestic transaction and cross-border transaction, but in many countries of the world is really, about cross-border transaction for the most part. Now, when you are trying to, examine transaction between two countries, between two companies operating in different jurisdictions, then it's important to also appreciate the fact that you would also need a bit of knowledge about the tax law of those other jurisdictions where those counterparties to the transactions are resident. Now, we do say that transfer pricing, actually, the knowledge is not restrictive. It's not restrictive in the sense that it is something, it is a knowledge that is applicable in many jurisdictions where you have transfer pricing rules, because the overarching concept, when we're talking about transfer pricing, when you are reviewing the price chart between related party, the overarching concept is really the arm's length principle. And that principle is actually applied in many jurisdictions of the world. Is a principle that stemmed from the OECD. OECD is the Organization for Economic Cooperation and Development, the body of countries that come together to look at issues affecting their countries from tax perspective, and they come up with common policy to addressing those issues. And if you look at Article 9 of the OECD Model Tax Convention, the arm's length principle is clearly defined there. And that knowledge, when you have it, you definitely can use it in many jurisdictions of the world. I think the other point to note about transfer pricing is that it's not an exact science. It's not an exact science because you really cannot say this is what the transfer price should be. It's not, you won't see in all the guidelines that we have, the international document that we're using to examine transfer pricing, to even the Nigerian transfer pricing regulation, you won't see any recommendation as to this is what the transfer price should be. So we say it's not an exact science, it's an art. And because it's not an exact science, it's an art, what that essentially means is that it requires an element of judgment on the part of of the businesses of the company, and also on the part of the tax administration, the tax authorities. Another point about transfer pricing in terms of characteristics is the fact that it's a concept that had been put together by OECD, particularly in terms of how we determine that transfer price. Remember, we said transfer pricing is the process of determining transfer price. Transfer price is an appropriate price that should be charged between parties to a transaction. And those parties in this instance, we're talking about related parties. They are related because there is an ownership. And that ownership simply means that one of the entity actually has the ability, or may have the ability, to control the operating decision of the company, the managerial decision, or even the financial decision. Essentially, the price of the transaction can be influenced by one of the parties to the transaction. And what countries of the world actually want is that appropriate tax is actually declared in their country around activities performed in their country. And the only way to actually achieve that is via transfer pricing, and the transfer pricing as determined under what we call the arm's length principle. So when we look at the unique approaches, right, for determining a transfer price, the first approach is really what is viewed as the international standard, which is the arm's length principle, the arm's length approach. And remember, what a arm's length approach simply says is, treat a related party, the way you are going to be treating someone who is not related to you. So if company B is my sister company and I'm having a transaction with company B, my transaction with that company B should be priced in a way that is not different from the way I will price my transaction with company C that is unrelated to me, for as long as we are looking at the same transaction and they are happening under comparable circumstances. So that's really the first approach in determining transfer price. And that's the approach that has been, universally accepted, applied over the years. It's got international consensus, and because of that, we say with transfer pricing, we really can eliminate what we call economic double taxation. Economic double taxation is actually a case where you have the same income taxed twice in separate jurisdiction. Now, when you have transfer price appropriately determined, you definitely can eliminate or mitigate that risk of economic double taxation significantly. The second approach is what we call, another approach is the global formulary apportionment approach, which we call GFA. If you look at the OECD transfer pricing guidelines, GFA is one of those alternative approaches that have been indicated in there, but it's not something that is really widely accepted. It's not widely accepted, even though in some jurisdictions they have used it on a national basis, but not across different countries. And remember, when I started, I mentioned that transfer pricing is more so about cross-border transaction, and how you determine the price for those cross-border transactions, even though in Nigeria, domestic transactions are within the purview. Now, to the extent that you are dealing with, across countries, transaction, you really need several countries of the world to be happy with whatever approach you're going to be using. So that is one of the, downside of the global formulary apportionment approach. And that approach is basically saying, can we determine the group profit and try to share the group profit across different members of the group based on some predetermined and mechanistic formula. And those formula could be based on payroll, based on assets, based on sales, and perhaps based on cost. Now, it's like I said, it's something that is not widely accepted. Another approach that we could consider in determining transfer price is what we call safe harbor. Safe harbor is basically saying, you may not follow the arm's length principle in determining your transfer price, but if the price that is charged for a related party transaction is actually, a price that had been approved by a regulatory authority, for instance, in Nigeria, let's say NOTAP, National Office for Technology Acquisition and Promotion, for transaction within their purview. If the transaction is approved by NOTAP in terms of pricing of that transaction, you really may not need to follow the arm's length principle in determining, an arm's length price. The transfer price should be viewed as the NOTAP approved amount. But I think there is a note of caution in that regard, because if you look at the Nigerian transfer pricing regulation, there's a comment in there that says that for that to happen, right, the NOTAP approved amount really should be to the satisfaction of the Nigerian tax authorities. And honestly, in practice, we've really struggled around that, aligning NOTAP approved amount with what the tax authorities would deem satisfactory. So that had been, there had been a conflict in that regard over the years. And particularly, if you look at the 2018 transfer pricing regulation that was released, it's clearly stated there that the tax authorities actually have, the prerogative to really determine what will qualify as a safe harbor. So you can see that even though it's one of the approaches, is really not viewed as, as a popular approach because of the, downside associated with it. Another approach, perhaps I should mention, is what we call the use of custom valuation. In some jurisdiction, In Nigeria, I must clarify that the use of custom valuation is not deemed as a satisfactory approach in determining transfer price for tax purposes. Now, let me also clarify that transfer price could be for several reasons. We determine transfer price for several reasons. But for the purposes of this conversation, I'm focusing it on transfer pricing determination for tax purposes. So the tax man, is not going to be happy with the use of the value declared for custom duty purposes as your transfer price for tax purposes. So if you have any value declared for that purposes, you will see that the Nigerian Tax Authority will do an independent review in order to determine, an appropriate transfer price for tax purposes.
Okay.
Maybe final point,
Exactly.
maybe final point on that is just the use of comparables, secret comparables. Now, in Nigeria and even globally, it's recommended that the use of secret comparables should be discouraged. Why should you have access to some information not in the public domain and you are using that as a basis of determining your transfer price for tax purposes? Because you can't share that information with the tax authorities under audit. So those other approaches are there, but as you have seen, based on this conversation, the arm's length principle is really the most appropriate based on what is commonly applied and widely accepted as of today.
Great.
Yeah,
Very exhaustive. Thank you for giving us the list of the approaches to transfer pricing. Moving on, and the concepts of transfer pricing declaration. Do they have a meeting point or convergence at all? Let's audience understand it.
All right, thank you. Transfer pricing declaration and transfer pricing documentation, they are actually separate compliance requirements within the Nigerian transfer pricing, regulation. The transfer pricing declaration is, when I look at that from transfer pricing returns perspective, it's just the form that you use to declare information about who are related to you, to the tax authorities, and you provide information about those related parties so that the tax authorities can know who they are, where they are situated, where they are resident, and perhaps the tax rates in those jurisdictions, right? And of course, you are expected to file as a connected person. You are expected to file that declaration form once, and you are not required to file subsequently unless there are material events that will require that you file. For instance, when you have changes in the in the shareholding at the parent level, at the parent company level, or at the connected person level, or at the subsidiary level, whether merger or acquisition, you will be required to update that declaration form. Now, what transfer pricing documentation, on the other hand, is essentially the set of data and information, the analysis that are put together in order to verify and confirm to the tax authorities that the transfer pricing has been done in line with the arm's length principle. Remember, I mentioned that transfer pricing really thrives on the arm's length principle. That's the international standard for determining transfer price for tax purposes. So keeping that in mind, right, the documentation that you prepare in order to verify that all has been done in line with the arm's length principle is what we call the transfer pricing, documentation. And the requirement is actually to have it in place when filing, tax returns, transfer pricing returns for the year, which is 6 months after the company's year end. And it says you're expected to have it in place, but don't file it unless requested by the tax authorities. When the tax authorities ask for it, the company has 21 days to provide it. Now, in terms of the meeting point for them, I think, in my opinion, the meeting point really is the fact that both documents can actually, be used as veritable tools in the hands of the tax authorities, for carrying out risk assessment, in order to identify good targets for transfer pricing audit purposes, right? When you file your TP documentation, your TP declaration, they can use both documents, the tax authorities can review and identify which companies are really good targets, for transfer pricing controversy purposes. Thank you.
Ah, wow, 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 wow. Thank you so much for that response. We are still on the show, ICAN on air, and we are discussing the topic unbundling the complexities of transfer pricing. Our guest on the show today is Mr. Temitope Uni, the partner at Tech Services, Ernst& Young, Nigeria. Mr. Temitope, we earlier mentioned the Nigerian transfer pricing regulation of 2018. So my next
Yeah.
question will be that, what is transfer pricing regulation? Why do we need this regulation? And possibly, what are the methods prescribed by that regulation for transfer pricing?
That sounds like 3-1. What's the transfer pricing regulation? The transfer pricing regulation is really, the legislation that we have in our Nigerian in our Nigerian transfer pricing framework to really give effect to certain provisions of the Nigerian tax law. I mean, transfer pricing, is really not new, right? In Nigeria, if you look at the Nigerian tax law, you would see that transfer pricing has been there. A very good example is the Company Income Tax Act. Section 22 of the Companies Income Tax Act talks about anti-tax avoidance provision, which simply says where you have transaction between related parties, right, the transaction really should be at arm's length. But we never had detailed guidance as to how to implement or apply the so-called arm's length principle, right? But there is a provision, there is a comment in that provision, section 22 of the CETA, that says that in the event that the tax authorities are not satisfied that the transaction is at arm's length or they view it to be fictitious or artificial, the tax authorities can do transfer pricing adjustment in order to really effect the arm's length principle. We never knew how to implement, the arm's length principle. We actually have that clarity um, introduced to us, released to us via the Nigerian transfer pricing regulation. Now, I would say the first regulation was introduced in 2012 with a commencement date of 2nd August 2012, right? And that provision was repealed. That regulation was repealed, and we had a new legislation enacted in 2018 with the commencement date of I think 12 March 2018, which essentially, like I said, is there to give effect to the relevant provision that we've got in our Company Income Tax Act, Personal Income Tax Act, Petroleum Profit Tax Act, Capital Gains Tax Act, Value Added Tax Act around, related party transactions. Now, to your point as to the purpose, I'll mention a couple. The first for me is really to give certainty to what we call tax treatment of cross-border transactions, right? Remember, I mean, investors want certainty anytime, any day. Certainty is what gives them joy, right? And in the past, prior to the introduction of the transfer pricing regulation, multinationals were applying the arm's length principle based on what they thought was appropriate. But I mean, in reality, the tax authorities actually could have, their own version of the application of the arm's length principle. So there was no no congruence, no alignment, in that respect. So the TP regulation was there to give certainty to the tax treatment of cross-border transaction. TP regulation was also released to provide, I would say, a level playing ground for both multinationals and indigenous companies. How do I mean? No one has got an undue advantage. I mean, well, the expectation is if you have related party transaction, price the transaction the way a third party would have priced the transaction. So whether you are a member of a group or you are outside the group, the reality is your pricing of transactions is expected to reflect the open market forces if the arm's length principle is duly followed. And that's one objective there, one purpose of the of the TP regulation. Another objective is really to fight tax evasion. Is a veritable tool in the hand of the tax authorities to combat tax evasion. Companies that have been, perhaps businesses that have been, moving profit out of the country on the basis of the lacuna in the Nigerian law, i.e., we don't know how to implement the TPO rules. No guidance, had been provided. All of those will be curbed by the release of the transfer pricing regulation. The other point in that regard really is elimination of the economic double taxation point, which I mentioned, I already described earlier. Maybe finally, I should also talk about, with the transfer pricing regulation, the Nigerian government can really get appropriate tax that is due to them based on the economic activities happening in Nigeria. Let it not be that you will have high value economic activities happening in Nigeria and you're going to be declaring profits way less than what you should have declared as a company. With the transfer pricing regulation, all of those can really be effective. Now, you mentioned that I talk about transfer pricing methods. I believe that's really the question. How do we determine transfer price? And that's really around transfer pricing methods. I won't go into the details because that could be a bit technical, but I'll just summarize. In determining transfer pricing method, there are two broad categories. There is the category that we'll call the traditional transaction method, and there is another category that we'll call transaction profit-based method. Under the traditional transaction method, we have three methods. The first is the comparable uncontrolled price method, which we call COP, which is what a layman, if you ask a layman, how do you determine an appropriate price between a brother and a sister? The layman will tell you, go and check the price at which that product is charged, is transferred in an open market. And if you get that price, that should be the proxy. That is what is expected. So that's really the comparable uncontrolled price. Now, the other method is the resale price method. The resale price method is basically saying, let's say I'm a distributor, I'm buying from a related party who is a manufacturer situated outside the country, and I'm selling that product that I'm buying, in, let's say, Nigeria to a third party. The resale price margin, which is gross profit expressed as a percentage of sales. When I determine that, right, in respect of my related party transaction, I'm expected to compare that with what a third-party distributor buying from another third party will make from reselling that particular product. But one thing is important in all of this methodology, we must consider comparable circumstances. It's important the product is comparable. It's important, we're looking at comparable, economic circumstances. It's important we're looking at comparable functions and whatnot. The third methodology is the cost plus method. Cost plus is basically saying, let's say I provide services, the cost that I incur in providing the services, I had a markup to it. The markup on that cost, I'm expected, to actually go check what an independent party, a third party, is making from a similar transaction, and that's expected to be comparable. The fourth one is what we call the transactional net margin method, and that compares at the net margin level. And that net margin is actually weighed, upon sales, upon assets, or the cost of the company, the tested party. And the last one is what we call profit split method. Profit split method is basically saying, where you have complex transactions where different parties are providing unique intangibles, identify a routine entity across those transactions, give the routine entity a routine profit, and whatever is left as profit shared between the parties providing the unique intangibles, providing the unique functions based on some appropriate metrics. I think I'll just stop there.
Okay. Thank you very much, Mr. Temitope Oni. For any student member or even professionals who could have possibly missed today's episode, I think we will say they are wrong, because certainly what you are doing today is you are actually unbundling the perceived complexities. Let's go on a short commercial. Let's go and showcase the wares of those who are with us. We'll be right back. Please don't go away.
The Executive Committee of the Institute of Chartered Accountants of Nigeria invites you to London for its 11th International Conference, to be held at the Hilton Kensington Hotel from the 13th to the 16th of March, 2024. Themed: Cross-border integration for economic resilience to be delivered by seasoned speakers who are subject matter experts with global renown. Conference will explore, amongst other topics, micro and macro factors necessitating cross-border integration, how international financial systems facilitates cross-border integration, artificial intelligence, and of course the role of the professional accountant. Conference highlights include special address by the 59th President of the Institute, plenary sessions, interactive sessions, and networking opportunities with UK domiciled professional bodies and professional colleagues from across the world. A guided visit of a famous London landmark and a visit to Westfield London White City, the largest shopping and leisure destination in Europe. Conference resident delegates get a VIP pass with exclusive access and offers up to 25% discount on high-end brands. Make your reservations now by sending an email to conference@icon-org.uk for more information. London awaits you. Plan, prepare, be there. ICAN UK Conference 2024.
As a finance professional in a disrupted business landscape, what does it take to be in demand? What does it take to attract great paying international roles? If you're an ICAN member, it'll just take one exam. That's all it takes to complete the globally recognized CIMA professional qualification and the internationally respected CGMA designation. As a CIMA member and a CGMA designation holder, employers will look at you as a finance professional, constantly acquiring new skills to add value to the business. That's why they'll be willing to pay premium to hire and retain you. If you have 5 years of relevant experience and are an ICAN member, you can directly sit for the final exam of the CIMA Professional Qualification, the Strategic Case Study exam. Start studying the CIMA Professional Qualification. Prepare to make an impact.
And we have been with Mr. Temitope Oni, complexities of transfer pricing. Let's quickly go and acknowledge some of our viewers, those who have joined us very early on time. We have Dr. Mrs. Aman from Owerri, Rufus Ajay Igbe from Ilasa Majamushin, Lagos State. We cite you. Olubenga Daniel Sholari, FC Adeniyo from Ibadan, Alex Fabi, Real One Usman from Ikeja, Olaleye from Lagos, Salah Adebayo join us from Lagos, Mohamed Inuwa FCA from Abuja, Adeshino Emmanuel Olubayo from Oshobo, Kale Jaye Ademola joining us, Igwe from Lagos, Okere Chima Obi from Bagada, and many people are on the show today trying to understand transfer pricing. Continue to send in your questions. We are already getting your questions, and at a proper time, I assure you, our guest on the show, Mr. Temitope Oni. Mr. Temitope, you are welcome again to the second part of the program after the short break.
Thank you, Mr. Kilmi.
Very much. Okay, so we were talking of the transfer pricing regulation, and so that which for non-compliance with transfer pricing regulation, especially in Nigeria. If yes, what are those penalties, and what are the conditions for possibly applying for transfer pricing and all that?
All right, thank you. In terms of transfer pricing compliance requirements, I think it's important we appreciate what those requirements are. I would say, from transfer pricing perspective, 3 requirements, even though we also have, about 2 requirements under country by country reporting, but I don't want to mix that with this, but I will touch on it just in a while. for a particular purpose. Now, in terms of compliance requirements, we have the requirement to file transfer pricing returns. Within that transfer pricing returns, there are two forms that are actually critical from transfer pricing point of view. The first is the declaration form that we talked about initially. There is also the transfer pricing disclosure form that is actually used to provide information about related party transaction, the nature of the transaction, the value of the transaction, the method that are used to support those intercompany transactions. And the TP disclosure form is meant to be filed annually, as part of transfer pricing returns. And the due date is, no later than 6 months after the company's year end. There is the transfer pricing documentation. Of course, we talked about that. Documentation is expected to be filed with the tax authorities upon request. And when requested, the company has got 21 days to provide it. Now, what are the penalties for not complying? For the transfer pricing declaration form, the penalty is, in the first instance of default, there is 10 million naira for not complying with, just completing that form, right? And the reason the penalty, appears very huge, not only in respect of declaration and also other compliance requirements, is really to enforce compliance, right? I recall in 2012 when the regulation was released, compliance was, was not as good as expected up until 2018 when they reintroduced the new transfer pricing regulation. And the new transfer pricing regulation was actually the one that introduced those significant penalties for non-compliance. And what we saw upon the release of the new regulation was that companies really started complying because they wanted to, mitigate, avoid those penalties. So 10 million naira for the first instance of default and 10,000 naira for every subsequent day of default for the declaration form. For the disclosure form, there is also 10 million naira or 1% of the value of transaction not disclosed to the tax authority, whichever is higher in the first instance of default. And subsequently, there is 10,000 naira penalty for default after the first instance. Now, for documentation, I would say 10 million naira or 1% of the value of transaction not documented, and 10,000 naira for every subsequent day of default. Now, what is important to keep in mind is that there is an amnesty, so to speak. The tax authorities, I think less than 2 weeks ago, released a public notice that companies who have not filed pending obligations should come forward to file those obligations. Now, and they mentioned that the condition for, taking the benefit of that public notice, which is waiver of late returns penalty that ought to, emanate from, not filing as a when due, will be waived. I mean, the condition really is to put forward those filings and put them across to the tax authorities via the tax pro marks. I mean, in the past we've been using what we call the TP platform, and they want to encourage taxpayers to come forward and start filing using the tax pro max. But beyond that, they really want those that are not filed returns to come forward, bring their returns, to the tax authorities. And for me, I think this is a welcome development for businesses who are yet to file. They should come forward and, regularize their compliance status. And, I would say see no more thereafter. Thank you.
Okay. We will go and see no and consultants will also advise their clients appropriately so that they are not penalized. Now let's go to our audience and take some our audience. Fagbolate Mitokwe Adeniyi is asking the question. So kindly amplify the tax haven and tax avoidance in relation to.
All right. I think that's a very good question. When we talk about tax haven, we're basically, talking about jurisdictions that have got a tax rate below the statutory tax rate in Nigeria, right? Our company income tax rate statutorily is 30%. So where you have a country that has below that, or that is really not paying, that has got zero tax rates, that jurisdiction will be viewed as a tax haven from Nigerian, tax point of view, or Nigerian transfer pricing point of view. Tax avoidance, on the other hand, is basically saying, how do you arrange your financial affairs as a company, right? Are you able to do that in a way to minimize your tax liability as a company? And that's really basically saying, are there loopholes within the Nigerian law that you actually can leverage to minimize tax liability? And that's the reason they taught us when we were in taxation class then, that tax avoidance is not illegal. It's tax evasion that is acrimonious, right? So tax avoidance, right, is just minimizing tax liabilities based on the provision of the law. And to your point as to how does it relate with transfer pricing? Now, I mean, you have a tax haven, and let's just assume we have a manufacturer that is situated in a tax haven, right? Let's say, for instance, let's say in Dubai, let's say in Cayman Island or Bermuda, and they are selling what they are manufacturing into Nigeria. They have a subsidiary in Nigeria, and they are selling what they are manufacturing into Nigeria. The tax rate in Nigeria is 30%, company income tax rate. And for the sake of illustration, let's say now that jurisdiction has got a lower tax rate, significantly lower than 30%. Now, transfer pricing is what is, how you set the price between those two parties for the transaction happening between them. The question is, what happens if you increase the price that you charge the manufacturer charges its subsidiary in Nigeria beyond the arm's length price? What will happen is you will continue to move money from Nigeria to, let's say, Cayman Island, and the Nigerian company will be reporting less profit, while the foreign entity will be reporting a higher profit. Now, the implication of that is you are exposing a higher profit to a lower than 30% tax rate, and the Nigerian profit is being reduced and exposed to a higher tax rate. So if you look at the group as a whole, they're actually managing their tax burden better, because their effective tax rate is going to be reduced as a result of the way they are shifting the profit between the two entities. So that is really how transfer pricing is used to allocate profits, or transfer or mispricing of transaction between related parties is used to shift profits from a high tax jurisdiction to a low tax jurisdiction, so that the group can have a higher profit after tax. That's really what we call managing the effective tax rate. But of course, transfer pricing is there to really curb that. If you do it well, that will be mitigated as much as possible. Hopefully, I answered that question with that example.
Okay. Thank you very much. The next question coming from Abuja says, please, how does the appropriate double taxation? How does the appropriate use of transfer pricing mitigate double tax?
All right. Let me use that opportunity to just quickly talk about the concept of double taxation. I mean, double taxation could be economic or juridical, right? But I'll just focus on economic for this purpose, because that's really the one that really concerns us. Juridical is an entity is subjected to to tax twice. Just a very good example is a PE in Nigeria, and a legal entity is subjected to tax twice. Now, but let's flip it to the economic double taxation that concerns us for this purpose. Economic double taxation is saying an income is subjected to tax twice in two different jurisdictions. Let's use the example that I set out earlier to demonstrate this. The income is in the books of the Nigerian entity. Sorry, the income is in the books of the Cayman Island entity, and the Nigerian entity is going to be recognizing cost. If the Nigerian tax authorities review that transaction and they're not happy with the price charge, what they're going to say is, there is a level of profit that should have accrued in Nigeria but had not accrued because of the conditions imposed between the two entities when carrying out that transaction, and they will determine an adjustment, and they would say this is the transfer pricing adjustment. They're basically reducing the profit they are increasing the profit of the Nigerian entity. As a result of that, the Nigerian entity will be paying additional tax in Nigeria. Now, remember that that transaction had been mispriced and they moved profit out of Nigeria to Cayman Island. The profit moved out of Nigeria to Cayman Island has been subjected to tax in that jurisdiction as well, at whatever rate applies to that jurisdiction. Now, that income, the level that is adjusted in Nigeria, is being taxed twice, essentially. It's been taxed in Cayman Island, and of course, is also taxed in Nigeria. That is double taxation in there. Now, how do you use transfer pricing to curb that? Assuming an appropriate price had been charged based on the arm's length principle, the taxman will come, review that transaction, and will say there shouldn't be any transfer pricing adjustment. I'm happy with this. If that is the case, there is nothing called economic double taxation. Everybody's going to be fine. Now, but I must say that in the instance where you have double taxation, for countries that have got tax treaties with Nigeria, there is a provision within the tax treaties that actually allows for what we call a corresponding adjustment, which simply means that in the other jurisdiction, whatever income or adjustment has been done in the first country, which is the primary adjustment, you definitely can get a corresponding adjustment in that other country. In this case, that would be Cayman Island, after the Nigerian tax authority would have done the adjustment. Now, remember the reason this is the case. The tax treaty is there to avoid double taxation. So they have that provision in there that says where you have this adjustment, provided the taxpayer applies to the tax authorities, they really can take it forward. So the tax authorities in Cayman Island will then ask the Nigerian tax authorities, can you confirm, why you've done this adjustment? If they find that, yeah, they've actually done it to really affect the arm's length principle, they will do a corresponding adjustment in Cayman Island. And with that, double taxation will be avoided or mitigated as much as possible. I hope I did address that question.
Yes, you did. Thank you very much for your analogy and for the examples given to explain that question. Thank you so much. Okay, as an experienced tax professional, Mr. Temitope, what is your unbiased assessment of the understanding and application of transfer pricing amongst Nigerian professional accountants? Is it excellent? Is it fair? Is it poor? What is your own unbiased assessment? And for whatever the assessment is from your own angle, what is the reason?
Well, that's a very good question. I would say it's fair, right? I would say it's fair, and if I'm going to be unbiased, I'm going to say it's fair, and I can understand a bit why it's fair. Let's not forget that the transfer pricing regulation was first released in 2012. 2012 down the line is between 12 to 13 years, essentially, right? So, I would say it's still not so much of time. I think people are still gaining experience. People are still, trying to gather knowledge as much as possible to do better. And the other points around why this is the case, why I think it's fair, is, it's actually a subject that require, a multidisciplinary team, right? You need a bit of knowledge on accounting, not even a bit. You need an in-depth knowledge on accounting, an in-depth knowledge on law, an in-depth knowledge, of business. You need an in-depth knowledge of of economics. You put all of these things together, you really need a lot of time, a reasonable, level of time to really digest the concept, to appreciate it well, and to really grow that knowledge. Now, the reason the gap is there in transfer pricing more so than you will see in tax is because, the general tax had been around for years. we have repositories of knowledge, right, in individuals, in tools, in database. Unlike transfer pricing that is just 13 years. I remember I remember when we started it then back in 2012. It really looked abstract, even to people like us that are consultants today. But we just took the bull by the horn. We looked at also the benefit. I think one thing that is important for our members, ICAN member, is the fact that we need to appreciate the fact that the knowledge is not restrictive. I think that's a selling factor. If you keep that in mind, that anywhere you are in the world, you really can practice, transfer pricing. I think that gives you an impetus. There is a kind of joy that you really cannot explain. I mean, if you find yourself in diaspora, you find yourself outside the country, it's very likely you will not spend so much time, before you get a job, because the knowledge is not restrictive. I think that should encourage us, and give us the impetus to go for the
Okay.
knowledge.
And in closing, Mr. Temitope, ICANN is
Yes, sir.
always open to ideas that would positively advance the growth of our organization and the business environment at large. Please, what is your suggestion on bridging knowledge gap and appreciation of the subject matter, transfer pricing?
Thank you, Mr. Akinwumi. I mean, I think I just have one answer in that regard: education, education, and education. That's what you're doing. This platform is there to share knowledge, and I mean, I'll just say, let's continue to do this. Let's continue to have these engagements. Let's continue to educate, ICANN members. I think as we do that, there are things that will definitely stay with them. They will appreciate the subject better. When we do our mandatory continuing professional education, let's continue to reflect the subject of transfer pricing, because it's really key. It's a challenge that they will see in practice, whether they like it or not. And one of the reasons is particularly important is because the the international tax arena is, I don't want to use the word volatile, but it evolves very fast. It changes very fast. You have development. I mean, currently they're talking about BEPS 2.0. When did we finish BEPS 1.0 that we're talking about BEPS 2.0? So imagine people who have not even attempted to get knowledge on BEPS 1.0. There is a gap, there is a lacuna there. So I'll
Okay.
just say, let's continue to engage, and and with that, people will be better and appreciate the subject better.
Wow. Let's engage, let's educate, and all that. Tech Services, Ernst and Young Nigeria, for coming on the show today. It's been a wonderful and excellent delivery, and for also coming to share your wealth of experience on this show to our members and also friends of the Institute. We say thank you so much for coming, Mr. Temitope.
Thank you, Mr. Akiwomi. Thanks for having me. It's a pleasure. I'm happy to be here to share my experience anytime, any day.
Thank you very much. You're welcome. Quickly, let me go and take the announcement we have on the show today. Within the next 1-2 minutes that I have on this show, program is coming up in the audit practice sector. The date is March 20th to Thursday, March 21st, 2024. It's a virtual program. The amount is 20,000. Please visit ICANN website to get registered for this MCPD training program. The March 2024 actual examination date has been announced to be March 26 to March 27, 2024. Registration is ongoing. All our student members of HATSWA should get this information and quickly register for the examinations. The 23rd Fellowship Conferment Program has been announced. The date is Saturday, April 27, 2024. Time 11 a.m. at Landmark Event Center. Amount is 175,000 naira for all members. All qualified members who are becoming fellow members, please get this information and go ahead and apply for the fellowship conferment and move to the next level of your career. Information Technology Conference, Digital Economy Navigating the New Frontier. The date is April 29th, 2024. The time is 10 a.m. It is a virtual program and the amount is 10,000 naira. These are the announcements we have on the show today. My dear professional colleagues and our global viewers, You would agree with me that today's program is worth the while, is very instructive, and is highly educating. We want to say thank you so much for being part of this show today. Till we come your way again with another guest, another topical issue, I want to tell you to stay safe and stay sound. On behalf of the producers and the editorial team, I'm Remento Sinyakinwumi FCA saying thank you for watching and bye for now.